I would say with that, it's 11:01 in Germany. We can start. This is also a recorded session, so it will be available for everybody that is maybe not joining today or needs to drop off a bit earlier. It will be recorded and put on our website. And I like to invite everybody to ask questions via the chat functionality. The chat is available for everybody. It is a great opportunity to get direct and first-hand knowledge from Tom. Tom, I'm very happy that you are joining today, that you take the time in your busy schedule to give us over the next 30 to 45 minutes a great overlook of what actually you're doing, what the macro outlook is, the interest rate outlook. And Tom, you have started at Goldman Sachs Asset Management, when I'm not wrong, at 2019 in the liquidity management team. So you're already a lot of experience in what is happening. You did the COVID, shock when there was a little bit more stress in the financial industry. So you are very capable and very experienced, and we are very much happy to have you here. Tom, the stage is yours.
Thank you very much. Thank you, Fabian. It's a pleasure to speak with you today. So as you mentioned, quick introduction about me. My name is Tom Griffiths, and I'm one of the portfolio managers in the liquidity solutions team here at Goldman Sachs. So we look after our money market fund solutions and also our short duration platform for GSAM as a whole. Before I dive in, very quick disclaimer that I have to make. So the views and opinions I express today are my own. They're for informational purposes only and do not constitute a recommendation by GSAM for you to take any action. And with that, I'll jump straight into the topic. So my plan today is to discuss the macro outlook. I'll start with the US, I'll then move on to Europe, and then we'll dive a little deeper into money market funds. So to start with the US, I mean, very eventful year. If we didn't have the uncertainties around tariffs weren't enough, we've now got the government shutdown that's just since ended, adding to all the kind of uncertainty and vagueness hovering over the US economy. Maybe if I kind of set the scene for the US as things stand, the labor market has generally been pretty strong until now, starting to show signs of weakness. Inflation was nearing the Fed 2% target earlier this year, but has since been creeping higher since the tariffs were introduced. So we were close to 2.3% of inflation at the start of this year. We're now at 3%. And so now you have these kind of opposing forces for the Fed to think about. On the one hand, inflation is high and been creeping higher. On the other hand, labor market starting to show signs of weakness there. And clearly there's starting to be a divide between the Fed on which takes priority and how they should act accordingly. If we think about the start of the year, so we actually had negative growth in the US, really driven by the tariffs and the uncertainty. If we think back to Q1, there was this big liberation day due to happen. We didn't really know what it was going to look like, what the effects were. And so you saw this real kind of front loading of US consumers importing goods from abroad because they didn't know how they were going to be able to access them, or how easy they were going to be access them, or how expensive they may be come this liberation day. And so you had this huge amount of importing, and that led to actually negative growth for the US in Q1. And then come to Q2, you have this huge bounce back. So once we're past Liberation Day and we get an understanding of what does this mean and where the tariffs sit, albeit them changing and still a lot of uncertainty with them, we now know where tariffs sit and which countries are being are facing tariff rates. And then you have this huge growth in CapEx spending from the AI kind of hyperscalers, as we like to think of. So between Amazon, Google, Meta, and Microsoft alone, Goldman estimate the CapEx spending of those four alone from last year to this year has increased by $140 billion. And that's just of four companies. So it really goes to show the amount of capital that's being poured into this AI story. And that's really been a driver of growth for the second part of this year so far.
Tom, a quick question.
And now we started.
I think
Hey,
I read
Sean.
it in the Financial Times. If you get the capex situation you just very nicely described with the huge investments out of the GDP equation, would the US be actually also in a negative GDP growth in Q2 and Q3? Or so was it mostly or only AI driven, or is the fundamentals of the US economy, even besides the investments in the AI sector, strong enough for a positive GDP growth?
Yeah, it's a great question. So they've obviously been a leading part of that growth and that turnaround, but you would still see have positive growth. So that negative growth that I mentioned in Q1 was really driven by the front loading of imports due to the worries of what Liberation Day would mean. If you strip out the impacts of this hyperscaler AI infrastructure spending, there's still fundamental strong growth across the economy. So default rates have been low. There's obviously been talk of kind of the odd high yield concern trickler, for example, on first brands, but generally default rates have been very low, and the average investment grade company's balance sheet is still very strong. So there's been a pickup in bond issuance this year. Banks have strong and healthy balance sheets. Overall, companies have healthy balance sheets. The consumer still continues to spend in the US, but there is this lingering uncertainty sitting over them. So we would still have expected positive growth, but potentially not quite the bounce back we did see without this AI kind of capital expenditure that's currently going on. Maybe just to give another example of kind of these AI kind of capex spending. So what we are actually seeing is the returns from the Mag 7 slowly actually declining year over year. We're also seeing the AI spending kind of had a lull in 24 and is picking up the returns on those AI companies, and the S&P returns as a whole are kind of slowly decreasing. So still strong, still very positive, but I think a key part is the Mag 7 aren't necessarily the one key driver that they were a couple of years ago, and we're starting to see this AI story kind of broaden out. There was in the most recent round of US corporate earnings, 60% of companies mentioned AI in their earnings releases, in the releases just gone. 2 years ago, it was just 15% of companies mentioned AI in their earnings releases. So that story of AI and the impacts and usefulness of it is kind of really broadening out across companies, and you're starting to see that kind of pick up more. And so that's driving growth in other industries as well. So a good example, so Goldman actually released the latest strategy about 2 weeks ago, and a part of that is really leaning into AI to improve efficiencies and kind of really drive the customer performance. Another good example is one of the legal firms in the UK now sends its new graduates to university to do a course in AI prompt engineering before they actually enter the workplace, to really get the most out of those lawyers once they enter the workplace. So you're starting to see this change in dynamic in the labor market. You are also starting to see AI kind of reduce hiring in the junior workforce, because a lot of those tasks are things that AI can handle well. But lawyers are a good example of where they understand the benefits of the junior workforce, but really getting more out of them from leaning into this AI rather than kind of cutting them out altogether. But it is probably worth mentioning, part of this AI boom is why unemployment has been creeping higher in the US. So we're kind of in this, if we kind of remove AI for a second, we've been in this kind of low hire, low fire labor market. And what I mean by that is we've had this big cycle of inflation moving higher, interest rates moving higher. We had this huge economic boom, and with that, companies hiring at a fast pace and generally hiring at expensive wages as inflation was moving higher. And now we're past that. Companies are hesitant to lay people off. They know the costs of rehiring people. And so we're into this world where companies aren't really hiring new people. They understand that's expensive, and they're not really laying off people, again, because that's expensive. And so they're just relying on kind of natural attrition to bring down their costs. but we do have this unemployment rate continuing to creep higher, and a part of that is this AI replacing junior administrative jobs that companies are no longer hiring for, and kind of leaning into this kind of new wave of technology, if you like. And then in the US, you have the tariff story that I kind of touched on earlier. And I think whilst it's important to remember that whilst tariffs aren't kind of front and center in the news right now, there's still some big countries which haven't had trade deals kind of fully agreed with the US. So China, there's been a lot of back and forth, but no kind of very formal deal set in stone. Brazil and India, also two huge players in the global market that haven't agreed trade deals. And what this really means is you have this huge kind of uncertainty weighing over the US. So GS actually did a study recently as tariffs were first being announced, and they found that with a one-off tariff increase, you would typically see that drop out of the inflation basket a year later. But what we're seeing here is the tariffs are kind of prolonged, they are unexpected, and they're shifting around. And that's really, that uncertainty is really feeding into consumer inflation expectations. And so from a 1 year, a 3 year, and a 5 year node for consumer inflation expectations, we sit at 3 or above 3%. So kind of a pretty worrying sign for the Fed, for something that they keep a close eye on. Also kind of important to note that US producers aren't really feeling the effects of the tariff increases. It's really the US consumer that's bearing the brunt of those tariffs, as they import goods from abroad and are now paying a higher price for doing that. So kind of taking stock of the US consumer, we're in this kind of low fire, low higher environment. Inflation has been creeping higher. Payrolls have been coming down and the labor market's weakening. Consumer spending is weakening, and the higher interest rates are kind of weighing on your everyday costs. So it's not a great picture and outlook for the US, but this high inflation is keeping the Fed from being able to cut rates because of their concern that that's going to feed through into second round effects. So what do we expect from the Fed? Well, they cut in October. The market's looking less and less likely that they'll cut in December, just given the lack of data. We had a pushback from Jerome Powell in the October meeting. We've had really a lack of data to give the market any signal that they have the grounds to be cutting interest rates. And so it's looking more likely that December could be a skip. And most likely the Fed will cut through 2026, but on a quarterly cycle. So using their quarterly meetings in March, in June, September, and maybe December to continue to cut rates then when they get a fresh round of projections and have had 12 weeks in between the last cut, which would take the rates down into kind of the low 3% from a US perspective. Then if I move on to
Tom,
Europe.
one quick question, because
Sure.
Jerome Powell is leaving as the chairman of the Federal Reserve next year, right? Is there any likeliness that a new one that might be more in favor of dealing with Donald Trump is reducing the interest rates because he gets a lot of pushback from Donald Trump? Is it something like that you factor in? So is it more likely, even if the macroeconomic data should set the scene for this, that next year with a new governor, we see more interest rates going down in a rapid pace?
Yeah, absolutely. I think if you rewind a couple of months, the market was kind of really hyper-focused on this worry that there would be a new central bank governor come in and they would cut rates really aggressively as soon as Powell's term had ended. I think what we've started to see is one of Trump's, I guess, loyalists, Stephen Moran, has entered the FMC now. He's pushing for additional cuts. There's a few other central bank governors who look to be in the race for central bank FMC members who are in the race for the governorship are starting to become more dovish. But then on the other side, you have others who are kind of making more hawkish noises and really laser focused on this inflation point. So I think we may see some more dovish names enter into the FMC mix. I think you're more likely to get a mix like the Bank of England, where you really have these two camps, one laser focused on the labour market and the weakness, and one laser focused on the inflation. And it will come to a swing, potentially come to a swing voter. So although there is that potential, it's less likely that you're going to see these really rapid and aggressive cuts that we thought maybe a handful of months ago, but something more steady kind of as this inflation labor market dynamics play out. Now, obviously, if there is a crack in the labor market, I think the Fed will be pretty quick to cut because they understand the risks that exist there for really letting the economy roll over. But as things stand, we think a kind of gradual and steady cutting pace is sensible for the Fed to go through. If we move to the US now, I think something we hear Christine Lagarde say kind of very regularly is things are in a good place. So inflation is pretty much at the 2% target. Growth is low, but pretty steady. Unemployment sits at the lows, and there's some expected tailwinds ahead from a fiscal perspective. So thinking about the effects of tariffs on Europe, although exports to the US have fallen by 15% through this year, shipments are actually up versus this time last year. And that's due to the front-loading effect that I mentioned earlier this year. There's also not been any kind of real signs of China dumping goods into Europe was a real concern when the tariffs and this trade war began. And we've not really seen any signs of that impacting the Eurozone economy just yet. So things looking kind of pretty good from that perspective. Growth, as I mentioned, has been fairly steady, so continues to trade somewhere between the 1 to 1.5% is expected to print there over the future. Now you have on one hand someone like a Spain that continues to post very solid growth and kind of mixed results through other parts of the Eurozone, but generally kind of pretty positive backdrop in general. And then I'll also mention the fiscal impulse. So obviously the German fiscal package was huge news in March. It's expected that a lot of that will be deployed over the next couple of years, and that's really going to see a boost in growth for Germany. And in fact, we think that fiscal shift from Germany will more than outweigh the fiscal tightening that's happening in France and Italy and Spain. But even as France goes through its consolidation, Italy's and Spain's is reducing versus where we have been in prior years. So all kind of a benefit to growth for the Eurozone as a whole. And then, so where does that leave us from a ECB and macro perspective? So the ECB has kind of regularly suggested that they're in a good place. As I mentioned, inflation hovers around that 2% mark. Inflation expectations are well anchored around that 2% mark now. And so the market's almost priced out any kind of cut. There's currently about 9 basis points of cuts priced over the next year. And then the curve slopes upward from there as the effect of the German fiscal package kind of takes hold. Now, where are risks to this? One will be the German fiscal package either being delayed in its spending. So if they can't find the right infrastructure projects to get invested in, or that takes time, or the multiplier effect that's expected of those gets watered down, you might start to see some of that growth wane. The second part will come from the inflation projections. So next year, the ECB expect annual inflation at 1.6%, and then it increases back to 1.9% in 2027. I think the real risk here is that 2027 number starts to get de-anchored and get too low and too far away from the 2% mark, and then that causes a worry for the ECB, and they're forced into cutting rates. And if they do, we think that they would cut rates more than once to encourage growth and getting back to that 2% inflation target. But kind of as things stand, the Eurozone seems in a pretty kind of steady place and kind of very consistent, healthy place when you compare to kind of the contrasting risks that exist in the US, for example.
Due to this, Tom, a quick question. Do you see that more and more US investors are moving to Europe to invest here? Because, yeah, we don't have the growth of the US, but it is a bit more stable, as you just interestingly described. Is it something that you as a whole see? And is it expected that it will also have a boost next year in terms of investments outside, inside Europe from outside?
Yeah, we've definitely seen I think really since March time, we've definitely seen a pickup of clients who are very dollar heavy, starting to think about diversifying their exposure. And one place is obviously Europe, just given, as you say, a very steady backdrop. Things look pretty healthy going forward, not much change in a rate perspective. And so that has been driving some clients to shift balances away from being very focused on the dollar to having some balances sitting euros as well. The other thing we have been seeing is corporate bond activity in the Eurozone picking up, just given the rate divergence. From a coupon perspective, if you can issue a bond in the Eurozone around a 2–2.5% coupon versus in the US, it's between a 4 and 4.5% coupon, it makes sense for them to be issuing into the Euro market where demand has been incredibly strong and technicals are incredibly tight. Credit spreads are effectively at the tights they have been for a number of years. And with each kind of new bond coming to market, they just continue to tighten. And so it's a very healthy backdrop for corporates to be able to issue there. So as I mentioned, for the ECB, it's very much looking like they'll be sat on pause for a while now. As I mentioned, it's very difficult to see any movement, and if there is, we think it would be another cut, and that being forced by the ECB starting to miss their inflation projections for the 27 mark. So really, we wouldn't see this play out until potentially at the earliest, really the March projection meeting, but more realistically, potentially sometime in June, for example, if it starts to become clearer that that 27 number is looking in doubt as kind of external factors play their way through the economy. So I'll wrap up there from a macro perspective and kind of move on to the money markets. And so why the importance of money markets, just given the uncertainty we've seen over recent years, kind of time and time again, the need to be flexible, to be agile, and to be able to kind of react in macro landscape is a perfect example of why money market funds are kind of a great vehicle. As you mentioned, Fabian, I've been in the team since 2019, and we've seen several once-in-a-lifetime macro events happen over that period. And so it's always a reminder to be on your toes, to be agile, and kind of the volatility that can come pretty quickly in markets. So I'll give a quick introduction to money market funds. I'll run through what a money market fund is and who might benefit from using them. Start with the latter question. We kind of like to think investors generally will have three pools of liquidity. And if we start with that chart at the top, I'll start from the bottom and work my way up. So your tertiary liquidity is really your long-term investing. So cash that you have for a very long-term project, you can park it away. You don't need to see it for a number of years. And so if you're investing that, you can invest it. You can take a bit more risk with that cash because you know you're not going to see it for a number of years. You're happy to weather kind of the storm over the next 6 months, 12 months, 2 years, etc. Then you get to your secondary liquidity. We think of this almost as your rainy day fund or cash parked away for a project over the next 6 to 12 months. So you want to take less risk than your tertiary liquidity, but you can afford to take some risk. You can afford to lock this up for a period of time. And often we see clients investing in something like a short duration product with kind of a 2 to 3 year duration on that kind of investment. And then you have your primary liquidity. So think of this as your everyday cash. So the balance changes every single day. You receive in payments from your invoices, your expenses are paid out. You need to be able to access this freely as the balance is consistently changing every day. It's this primary liquidity, your everyday cash, that's well suited to a money market fund. And why is that? Well, a money market fund is an open pooled vehicle for a stable NAV product. A client will invest at a price of 1. When it comes to redemption, you'll receive back your proceeds at that price of 1, and in between you receive the income that you've accrued along the way. The primary objective of the money market fund is capital preservation. It's to provide stability to clients, and then finally it's to produce a yield for our clients. And so how does this work? Well, so your money market fund isn't a bank account. When it's invested the cash that gets invested into the fund, we then invest into high quality debt from issuers from very tight regulations that we're permitted to invest into. And the reason that the regulations are so tight is to guard that you buy in at one and you exit at one, that capital preservation stability for our clients. So there's very tight regulations on all of the key metrics we need to post for clients, as well as what we can and can't do in these funds. And it requires us to only invest in very high quality assets for our clients. The cash that's invested with us, it's with a custodian too, so it's never actually held at GSAM or any investment manager. It's held at an external custodian, and there's a separate transfer agent that effectively is the register of who is invested and how much they've invested. So there's a number of safeguards in place, as well as being invested in a diversified portfolio versus having concentrated exposure with a single counterparty. So for example, our funds typically will have over 100 different holdings in the portfolio. And so when you think of that versus having all liquidity with a single bank account, I think a good example is Silicon Valley Bank or Credit Suisse of 2023. That went from concerns about a Silicon Valley Bank liquidity to a run and eventual collapse on Credit Suisse within a number of weeks. And I think really shows the importance of having liquidity in a diversified place and segregated away from concentrated with one single bank. So it's not to say we don't think there should be bank accounts. We don't think clients should use bank accounts. Absolutely, they should, and they'll be used for daily payments. But what we do say is excess cash that you don't need in that bank account immediately is better to be invested in a money market fund. Hopefully it can earn you a higher yield than the bank can offer you, but it's that diversification benefit and ability to access those funds on the same day that really kind of makes a money market fund work well for our clients. And so then something that we spend a lot of time thinking about from a portfolio management perspective and trying to kind of differentiate ourselves from our peer group is that not all money market funds are equal. And we kind of really lean into clients to encourage them to think about returns on a risk adjusted basis. So how much risk is your portfolio manager taking for you to earn those returns? Now, two things that we do to kind of stand out versus our peer group. One is running our higher liquidity levels than peer group and higher exposure to governments. The reason that we do this is just to absorb more flows, to sit on the more conservative side and still be able to provide a yield to our clients. And then the second part is how much risk are we taking in the portfolios? And so we limit the amount of risk in our portfolio at any one time, so that if we were shocked, similarly to what we saw in COVID, we would still be comfortable paying out our clients on that one-to-one basis that I mentioned earlier.
Tom, that's a very good explanation here. Thanks a lot. We got one question already yesterday, and I think here it is a good time to raise it up. One potential client of ours actually was asking how you as a fund manager make sure that at every point in time, under all circumstances, all withdrawals can be proceed. Specifically, I know you're managing tens of billions, but if there are, let's say, bigger withdrawals happening at one point in time, that the clients always are more or less on the safe side to get at any point in time their money back on the bank accounts. Can you go a little bit deeper here in describing how you try to make sure that this always is happening?
Yeah, of course. So I think there's two key parts. One is the underlying client investor base that we have. And so any client that is approaching 5% of the fund as a whole, we want to have very close ties to them. So to really understand what is that cash doing, when are they likely to lean on that cash, when will they need to withdraw from it, and if they do need to withdraw from it, we need to be given a heads up in advance so we can make sure we're prepared. So from an underlying client, anyone getting large in the fund, we're very tight on them to understand what their flow activity is likely to be and when we're likely to see inflows and outflows. The second part is then the liquidity that I mentioned. So the money market fund regulations require you to have 10% of your fund sitting in overnight liquidity. We tend to have between 30 to 40% of our fund in overnight liquidity, and then typically another somewhere between 10 and 15% of the fund invested in government securities that can also be liquidated to meet client redemptions almost instantaneously. So effectively, we have 60% of the portfolio ready to meet any client redemptions when the regulatory requirement is just 10%. And that liquidity amount is usually considerably higher than our peers and moves even higher in a stress scenario. So think of a COVID, think of an SVB, we were running our overnight liquidity more like 50% than our exposure to governments above that as well. So we've kind of run on a very risk-averse basis and then have that good understanding of our underlying clients and what their expectations are.
Yeah, thanks. That's a very good explanation, and I think very, very much ensuring of the whole liquidity concept of money market instruments. And I think also because we have a lot of clients also that use UnitPlus Business here today, in the two products we are using from Goldman Sachs Asset Management, I think also have in total roughly 30 billion euro in assets under management. And also, correct me if I'm wrong, Tom, but the volume of a money market fund, also the higher the volume in general, the easier it is to withdraw the money at any point in time. Is that fair to say?
Yeah, exactly right. So we offer a number of money market funds depending on the client's needs. The largest, as you mentioned, is about a 30 billion euro portfolio on its own. And the larger fund just means clients can move in and out with comfort that generally there's not going to be one client who dominates the fund as there may be in a smaller fund. And just given that, it's much easier to move liquidity in and out, and kind of flows even up to the hundreds of millions will have very small impact on our overnight liquidity on any given day. So just that size helps us be able to work with clients and make sure that their redemption needs are met at any time. The kind of second point I would maybe mention from a risk management perspective, I kind of touched upon, was thinking about how we stress the portfolio in another COVID-like example, and then going a step further is thinking about the risk that we want to take and who we're taking it with. So not just which names are we investing in the fund, but also who are we buying those names from, and making sure that we're investing with people that have a known track record of providing liquidity and bidding back paper, even during times of stress. As we mentioned, we've been through enough stress episodes, we've tested enough dealers in different times of market conditions to know who says they will bid back on their paper and who really will bid back on their paper when the market is getting stressed and liquidity is thinning up. And it's really leaning on those key counterparties that may not always be the very highest paying in the market, but we know we have that stability and their ability to access liquidity as and when we need to. The second part of having that government exposure means that we're then selling into a different buyer base if we need to sell government exposure versus selling credit exposure in the money market fund. So it just gives another pool of liquidity, another way to access, as I say, somewhere between 10 to 15% of the fund from a different liquidity base versus the credit that we're owning in the fund too. So with that, I'll kind of stop on the money market fund piece, maybe just as a go forward. There had been a lot of discussions around changes in regulation. We've seen changes in regulations come in from the US. There's been discussions about it in Europe and potentially slightly increasing minimum liquidity thresholds, but nothing set in stone as of yet. And so as things stand, it's likely that the money market kind of landscape stands as it is for a period of time. Happy to stop there and then take any questions.
Yeah, a second one that was also raised a couple of days ago already is in general how you position euro-denominated money market funds in the current environment specifically, and you already mentioned it that French might have some current issues that they need to tackle in terms of debt to GDP ratio and so on, and a little bit more instability in the government. Is this something that you would say is just a normal happening in your almost day-to-day work, or is it something where you would say generally with your experience and what the team says currently there are some things to be a little bit more cautious about that might affect in the midterm also the yield you can provide for your money market instruments?
Yeah, sure. So for France specifically, so the market has actually been incredibly calm about France this year, despite the uncertainty, despite the kind of back and forth, the lack of budget, the no confidence votes. And I think part of that is because the people that were concerned about France left the market last year when there was the initial volatility. Having said that, because the market's calm now doesn't mean it's going to be calm tomorrow or in a week's time. And so we have been slowly reducing our French exposure as a whole, and again, keeping an eye on the amount of total France risk we have in the portfolio. So we're comfortable with some France risk. We don't think that France or the major French banks are going to be unable to pay their debts in a week or a month's time, but we are cognizant that further out there may be some more concerns, and so we've just been reducing down that risk as a whole. And that then kind of feeds back into my point of choosing who we invest with, which names we invest with, and choosing a more higher up in quality fund and leaning into government exposure. So where we did hold French government bill exposure, we've slowly been rotating into the likes of EU, the likes of Austria, Netherlands, others, just to diversify that as we get the opportunities in the market. To your second point around how we positioned as a whole, so we've been increasing the WAM, or the duration of the portfolio, over recent weeks. As I mentioned, the curve is incredibly flat. There's very little priced into ECB cuts for the next year or so. There is an upward sloping curve, so the longer you choose to invest, the more you can pick up for your investors. And so we've typically been adding a mixture of government bills into the portfolio at longer tenors and increasing the credit, the tenor of credit investments, all with the view of this is additional pickup in yield for our clients, which works well. And on the off chance that the ECB do cut, and I think that is a non-zero chance that they're forced to cut next year, just given that inflation I mentioned. If they do cut, they're likely to cut more than once, and that will really benefit our investor base as well. So we've been kind of leaning into extending the WAM on the portfolio. That doesn't mean we're taking additional risk, but just choosing the instruments to do that to hopefully benefit our clients today and if the ECB cuts.
Great, that's really helpful. And maybe one last question from me, but if there are any other questions from the audiences, feel free to raise it, to bring it in the chat. Because Tom, I'm actually, I find it interesting that you haven't mentioned the US midterm elections happening next year. This might be a reason because it's a non-event maybe for the money market industry in Europe, or it is a little bit uncertain what it actually will apply. But my question is around, can specifically the midterm elections in the US have a bigger impact also for European economies, European interest rates, keeping in mind, Tom, that most of also our client base are doing most of the business in Europe, having a close eye on the interest rate here in the European Union. So is there some, let's call it, bigger effects that might potentially get activated during the US mid-election also for European countries?
So I think it's a good point, and that I didn't mention it. I kind of felt there were so many things going on in the market almost today that it's hard to jump forward into next year without mentioning AI, without mentioning tariffs, etc. But absolutely, it's important for the global economy, for the macro landscape. My expectation is that if anything, the market may there may be some volatility right around kind of the midterm election date, and potentially it skews the setup of the US government for the following 2 years. If anything, it is more likely. I mean, we're seeing a lot of executive orders go through in the Trump administration. That seems to be kind of very clear, and that can continue to be the case almost regardless of the outcome of the midterms. Potentially, there are more. There's more infighting. Potentially, there's more kind of these government shutdowns, government impasses as they struggle with kind of debt ceilings, and so you would see a feed through from the uncertainty and the volatility feeding through into European markets. Now Europe has a trade deal agreed with the US. I think there's less of an immediate direct one-to-one impact on the European market, but I think it's more that general volatility, general uncertainty will affect the global economy as a whole, and through one of those mechanisms finds its way back to Europe. Maybe that's versus the kind of the China route, maybe it's versus the energy route, but I think ultimately Europe should and will care what happens in the midterm elections, even if it's not a kind of one-to-one direct impact as a result.
Great. Yeah, thanks, Tom. So maybe in conclusion, also from when I was listening to your words, Tom, we can say overall that there's light and shadow, so to say, I guess, as always, that while in the US, the interest rate behavior in the next quarters might be a little bit more uncertain, how fast the Fed is decreasing rates here in Europe. It seems like also due to the almost 2% inflation. I think last month in Germany, we had 2.4%, so a little bit higher than on average, but the interest rates might be the same, and market, I think, I wrote it down, just estimate 9 basis points next year in decrease. I think this is a very interesting information also for every business owner when it comes to maybe raising debt, not only investing money, but that also, and that was the second part, Tom, also when we speak with a lot of potential clients, how money markets and the whole industry operates in general. You really described it very nicely, and also how much you and your team need to look for, be also listening to macroeconomic, microeconomic, regulatory changes and so on. So that really due to this also diversification effect, the risk management effect, it's an asset class that is really built for liquidity parking, how I always like to say it, as long as it is not needed in the operations, and it is widely used for decades with big blue chip companies. And in Germany with UnitPlus Business, we also like to, with a strong and very thankful partnership with, for example, you guys from Goldman Sachs Asset Management, like to also bring it more to the German Mittelstand, small and mid-sized companies and bigger startups. And Tom, I think you gave us a very good impression today also of your day-to-day life. And with that, I like to thank you for taking the time, walking us through over the last 45 minutes. One quick final question in terms of housekeeping. Is it allowed that we can send the presentation slides to the audiences, Tom?
Let me check on that. We should be able to, but let me just double check and then I can come back to you.
Great. Then with that, I would also like to thank everybody listening today. Tom, once again, thank you. And we wish you a good job also, obviously, for the future. And everybody else also a great Wednesday noon and afternoon. Goodbye. Thanks.